Hello and welcome to the lecture for part 1 of chapter 2. So in chapter 2 we're going to talk about accrual accounting. So in chapter 1 we did some really kind of rudimentary financial statements that were based on cash transactions. Well, that's okay for very small businesses, but most businesses grant credit and receive credit. So they sell things to people that they can pay for later, and they buy things from suppliers that they can pay for later. So when that's the case, we need to use accrual accounting, and I'll talk more about that in this chapter. So we'll start out by talking a little bit about horizontal financial statements and taking a look at that. Most of what I'll talk about in this part of the lecture will be on receivables and payables. That's money we're going to receive in the future and money we're going to pay out in the future. In the second part of the lecture for this chapter, I'll talk about financial statements that reflect those kinds of accrual entries, and we'll talk about notes payable and interest expense as well. And I'll talk about causes for changes in balance, so how we can kind of do a little bit of detective work. If we know a couple of things about an account, we can determine things that we don't know. And then I'll give a brief overview about corporate governance, which I'm not sure why the publisher stuck it in this chapter, but it's in this chapter, so we'll talk about it. So the big thing about accrual accounting is that we want to recognize revenues when we provide a service or a product, not when we get paid later. So think of an extreme example. What if I sell $100,000 worth of picnic tables to a customer and I deliver them all in December of my first year, and that's my only sale, and the customer is not going to pay me for 30 days, so I won't get the money until next January. I've incurred all the expenses to make those picnic tables this year, paid all my staff, I rented a factory, all of that occurred this year, but I don't get the money until next year. So when I'm doing my financial statements at the end of this year, remember I talked about financial statements tell the story of how we did. What makes more sense to say how we did? That I sold zero or that I sold $100,000 worth of product? Of course, it makes more sense to say I sold $100,000 worth of product, even though I didn't get the cash yet. The same thing with expenses. I want to recognize expenses when I incur them, not when I actually write the check later. Okay, so I want to recognize expenses when I incur them, which is related to the revenues that I'm pursuing when I incur the expense. So accrual accounting is required by generally accepted accounting principles. So all but the very smallest companies do need to use accrual accounting. So the one thing about accrual accounting is it does require some judgments to be made. So in terms of when expenses are actually incurred, doing things just by from a checkbook, when I get cash and when I pay cash, is very black and white. So accrual can be a little more gray. There could be some judgments involved, but that's okay. That's how we tell the most accurate story of what we're doing. So here's an example here from chapter 1. Now I've added some column here, or a couple of columns actually, where we did the assets equal liabilities plus stockholders equity in chapter 1. Now I've added some columns for income statement, revenue minus expense equals net income. So now, for example, on line 4 there, where I have that $85,000 in revenue, I show that in the retained earnings column, but I also show where it's going to be on the income statement. And in some cases, it's NA. It doesn't show up on an income statement unless it's revenues or expenses. But you can see the $85,000 under revenue there, and then I've got the $50,000 of expense. That tells me, did I make money or lose money? I also have information under that cash flow. So I've got financing activities, investing activities, and operating activities, 3 different types of cash flow. So that first transaction where we get money for issuing common stock, that's a financing activity. Same thing with borrowing money, that's a financing activity. The $500,000 that I use to buy land, that's an investing activity. Any activity that relates to long-term assets is investing, either buying or selling. Now, selling things to customers on credit and selling things to customers rather and incurring expenses, those are operating activities. That's the purpose for which we're in business. So they had a net $41,000 inflow of cash, which makes sense. If we look back under the cash column under assets on the balance sheet part, you can see we started at 0 and ended at 41. So we've recorded what has occurred with regard to cash flow. So now I mentioned I was going to talk about receivables and payables. So let's start with accounts receivable. So accounts receivable is the amount of cash the company expects to collect in the future for work that they do today. So example, when I provide services to customers, say I do work for customers to the tune of $84,000 and those customers are all billed and they're going to pay me in 30 days or whatever the case is. Instead of cash increasing, now I just have a different asset increasing called accounts receivable, money I'm going to receive. Sometimes if the book will say we provided services to a customer on account. What that means is they didn't pay immediately, they're going to pay later. And when somebody's going to pay later, that generates an asset, which is money that's due to me. So in this case, accounts receivable goes up, retained earnings goes up, I reflect the revenue on my income statement. Notice that it's NA for cash flows because no cash changed hands as a result of that transaction. Now 30 days later, let's say some of those customers pay me, I'm going to increase cash of 60,000 and my receivables will decrease by 60,000. That's one of those asset exchange transactions. Notice I don't increase retained earnings and I don't recognize revenue when I'm getting paid money that is owed to me because I already recognize the revenue when I provided the service or the product. So here I do have cash flows associated with that. Now, accounts receivable, if that's money that's coming into me, and I could have other types of receivables too. I could have receivables from employees if I give them advances on their paycheck. I could have a note receivable from a customer that's going to pay me over a long period of time. So we could have different kinds of receivables. Mostly we'll deal with accounts receivable. Its counterpart on the other side of the balance sheet is accounts payable. That's the amount of cash that I expect to spend in the future. So I might incur expenses now and I'll have a payable in the future. Accounts payable usually deals with suppliers to my company. If I buy office products or I buy inventory or maybe my cell phone bill or those kinds of things, I'm going to increase accounts payable and pull down retained earnings with an expense. That's a claims exchange transaction. One type of claim is going up, my liability. Another type of claim, stockholders' equity, is going down. So in this case here, we have incurred some salaries payable. So people did work for us, we owe them money. Instead of lumping that in with accounts payable, all the money we owe suppliers, we keep a separate category for that called salaries payable. So salaries payable goes up by $6,000. I owe my employees money, and retained earnings goes down by $6,000 because I recognize an expense. No cash flow associated with that. That happens a lot on companies that maybe have a payday on the first of the month. So on the 31st of the previous month, I owe the money. It's a liability. Later when I pay it, cash will go down by $6,000 and my salaries payable will go down by $6,000. That's an asset use transaction. Both sides go down. And notice I don't recognize any hit to retained earnings. I don't recognize an expense when I actually pay my employees in the following month. And I recognize my outflow of cash. So I'll also record some practice exercises as well. So be sure to look for that video as well. And I will talk to you again when I lecture on part 2. Thank you.